Hello, welcome back to the show. So in today's video, I'll be talking about when I'll be adding to my stocks again. So in today's video, I'll be covering a few things. We'll be covering when I'm planning to start buying again, how to think about valuation and returns, as well as some questions that you guys have left me in the comment section below. So these are my positions over here. I have United Health, S&P Global, Moody's, MSCI, MasterCard, Visa, Meta, Google, Microsoft, Amazon, as well as ASML. So for the first stock over here that I'll be talking about is none other than United Health. So United Health is a new holding of mine. It's a risky holding, but a deep value one. So currently now it's trading at a 12 times earnings, and year to date is down around 40%. So for United Health over here, here are some of the headwinds that the company is facing today. So the company has just been getting a lot of bad press these few days. So there's bad news every single day. You have the CEO getting fired, you have Brian Thompson getting assassinated, you have your Medicare fraud, poor sentiments, and regulations with PBM as well. And this is what United Health basically responded to the Medicare Advantage audit over here. So they said, we welcome CMS announcement to audit every Medicare Advantage plan each year, a policy United Health has long publicly advocated for to strengthen program oversight. We look forward to working with the CMS to develop an accurate methodology and appropriately use advanced technology to greatly enhance the auditing process. We share in CMS commitment to strengthen program integrity effort and ensuring Medicare Advantage beneficiaries have access to high-value, affordable care. So for United Health over here, they're basically responding and hitting back and saying that they welcome the audit. I think it's a good statement that they put out over here, but the stock still fell today. So for United Health over here, this is the valuation for the stock. So the stock is currently now trading at a 12 times earnings, and assuming the EPS drops around $21 or so from its current EPS of $24, and assuming an 18 times multiple for this stock is a $378 stock. So historically, this stock has traded at around a 20 times earnings. So my assumption today is that it will drop EPS by around 20%, and I think it is a good add at today's price. It is around 20 to 30% undervalued, so there's quite a fair bit of margin of safety over there. Next two stocks is S&P Global as well as Moody's, your credit rating agencies over here. So here are some of your headwinds for credit rating agencies. So high interest rates could drive down the credit market again, decreasing loans and debt due to high cost of debt. So if you have to look at the 10-year over here, over the past month or so, the 10-year has been rising almost every single day amidst all the tariff war and amidst all your different uncertainty that's happening with the US dollar or so. And this could be a headwind for earnings for S&P Global as well as Moody's over here. And then the other portion, the other headwind for this business is simply just the high valuation itself. So if you have to look at S&P Global as well as Moody's valuation over here, both of them trade at a 40 times earnings. So 40 times earnings is quite rich for any given company. And although these two companies over here are extremely high quality, I think a 40 times earnings seems a bit rich for both of them. So for Moody's and S&P Global over here, although they seem expensive now, over the long term, they could be cheap as well. So for example, Moody's over here has compounded revenue at 10% over the past 20 years. I don't think any other company has been able to do that apart from maybe Microsoft or so. It's just incredible. So over the long run, the longer you hold, the more value you get from quality businesses like this that can compound over time. So although it is expensive today, over the long run, these two stocks over here, S&P Global as well as Moody's, they will stay here for a very long time and they will help you compound your returns over time for sure. I'll be interested in Moody's at $380 and I'll be interested in S&P Global over here at $440. Those two will be the prices where I'll be looking into adding to my positions for Moody's as well as S&P Global over here. Next stock over here is MSCI. So MSCI is the king of your world indices over here. You have your MSCI China Index, you have your MSCI Emerging Markets Index, and you have all your other world indices as well under this whole branding over here, which is MSCI. So for MSCI over here, here are some of the headwinds for the business. The only primary headwind that I can see for this business is simply just a bear market. Because when a bear market comes, people will start to panic and then they will start to sell all the different assets and all that. And then when your assets under management drop, that's when MSCI lose out on earnings. But if you have to look back at 2020 as well as 2022, those two bear markets, revenues grew for MSCI. They didn't grow as much as the previous years, but they still grew at a healthy high single digit over here. So MSCI is clearly a high quality compounding machine. And for me, I think MSCI is a quality business that will just stay here for a very long time. So for MSCI over here, here's my valuation for it. So assuming a 13% free cash flow growth over the next 5 years and an 11% free cash flow growth for the remaining 5 years over here, I think it's doable for this business. They grow revenue between 11 and 12% or so, and assuming a 1% to 2% increase in margins, that will easily give you the 13% already. And for MSCI over here, the stock now is having an intrinsic value of around $544, so I think it's around fair value right now. currently around fair value, so I'll be interested to add to this one at around $500 a share. That's when I'll be adding to my position in MSCI over here. Next stocks over here will be MasterCard and Visa. So MasterCard and Visa over here, they're currently trading at historical high valuations. So for Visa, for example, on the left hand side, Visa is currently now trading at a 36 times earnings. MasterCard is trading at a 40 times earnings. And year to date, Visa is up a healthy 14%, beating the markets by around 14% or so. Same thing for MasterCard. It is healthily up year to date as well. So for MasterCard and Visa over here, they are the most overvalued of the bunch of stocks that I have, and I will likely trim them soon. But they are the highest quality businesses in the entire world over here. So another 10% more to go for me to trim my position. Maybe when Visa goes to around $400 a share, when it's around a 40 times earnings, when MasterCard is around a 45 times earnings, that'll be where I'll be trimming my positions. But overall, I don't plan on selling them. They are still a very small component of my portfolio, and I plan to add to them if the stock prices come back down again. So these two positions over here is just a long-term hold for me. I don't think I'll be selling out of this one anytime soon. Next two stocks over here will be Meta as well as Google, your advertising companies over here. So here are some of the headwinds for Meta and Google. So they're cyclical in nature because in economic conditions, when you have economic downturns, people spend less on ads. And the only way for them to basically make up for the decrease in ad spend is to increase prices on the ads. And then that leads to even less people paying for the ads. So it's sort of like a spiral whenever you have bad economic conditions. But when you have good economic conditions like what we're having right now, you could see inflated earnings as well. Meta grew revenue by 16% last quarter. It's just incredible growth year on year, and that is what you typically see for startup companies, not so much companies that are as established as Meta over here. So look back at 2022, for Meta and Google, they are historically quite cyclical. In 2022, their earnings dropped by quite a fair bit because we had a downturn in that year as well. So for Meta and Google over here is when I'll be adding to my position. Meta is probably the riskier out of the two, with a highly concentrated business over here. They have only one portion of the business, which is your advertising portion, whereas Google has your Google Cloud, your YouTube, your Waymo that could be profitable as well. I have a full position in Google already, so I'll unlikely be adding into this one. But Meta will be interesting at around $500 a share. Currently, Google I think is still undervalued. My fair value for Google is at around $190, and so I think it's a decent add at this price as well. Next two stocks over here will be Microsoft as well as Amazon, your two highest quality businesses out there. So for Microsoft and Amazon over here, they are probably up there in terms of business quality in tech. These two companies are almost irreplaceable unless they get sued to break up from regulation itself. Microsoft is at fair value, Amazon is also at fair value. So for Microsoft over here, I think I'll be adding at around $380 a share. That was when it was trading just a month ago, and currently now I have around 5 to 6% of my entire portfolio in Microsoft over here. Same thing for Amazon. I have around 6% of my portfolio in Amazon over here. I'll be looking to add at around $180 a share. Currently now it's trading at around fair value or so, and the worst is over for Amazon already unless we go to 200% tariffs on China. Last stock over here is ASML. So ASML over here, they create these machines over here. These machines, they are almost as tall as 2 school buses over here. So for ASML over here are some of the headwinds for the business. There's innovation risk for this business because this business over here, they have to constantly innovate to stay ahead of competitors. You have your China risk as well because China is coming out with EV machines that could replicate what ASML is doing already. You have your export controls as well because Trump could impose some sort of export controls to further limit China from more DUV access over here. And the last portion over here is the cyclicality of this business. So if the foundries stop buying the machines and use whatever they already have, this could lead to slowing growth for ASML over here. So ASML over here is clearly quite a high risk business over here, but it is a high quality business over here. So for ASML over here, here's my valuation. So the company now is trading at fair value. I have a full position in ASML already. It is almost impossible to measure ASML lead against its competitors, and that is the risk for this business. And that is why I don't plan to make ASML an extremely concentrated position over here. It will likely just stay where it is today. It will look interesting again at around $600 a share, but my next add will probably be at $500 a share given that I already have a full position in ASML. So for ASML over here, I view it as a high quality business currently trading at a fair value. If you have a long time horizon for this one, I don't see a problem with adding at today's prices. Next portion over here, I'll be talking about how to think about valuation as well as how to think about returns over here. So there are 3 ways for you to basically value a company. You have your multiple valuation over here, your relative valuation, as well as your asset-based valuation over here. So let's talk about multiple valuation first. So multiple valuation is simply just all your different ratios over here. So your PE ratio, your price to free cash flow, your price to sales. your price to book over here. So your PE ratio and your price to free cash flow, they're normally used for any company in general. Your price to sales is normally used for high growth companies, because for high growth companies, they don't have extreme profitability yet, and that's why their PE ratio could be overextended, they could be overinflated, and that is when you use your price to sales to basically justify the price. Next one is your price to book. So price to book is normally used for companies that are in the banking sector as well as your financials. And the lower the ratios in general, the cheaper the company, meaning to say your future expected returns could be higher if these companies are trading at a lower ratio over here. But the problem with this is it doesn't factor in the quality of the business, meaning to say a company that's trading at a low PE doesn't mean it is a good company. A company trading at a high PE also doesn't mean that it is a poor company over here. Next valuation method is your relative valuation method. So it is sort of like a comparison with peers in the same industry. So for example, Google is trading at a 19 times earnings, Meta is trading at a 25 times earnings, therefore Google is undervalued. That's how you use your relative valuation over here. But this method is flawed. All companies in the same industry could be overvalued. That is one factor. And it also doesn't factor in a specific company's growth in the same sector over here. So for example, Meta is growing 16%, Google is growing at around 10% or so. So there could be some sort of discrepancy in terms of valuation simply because one company is growing a lot faster than the other. So it doesn't necessarily mean that Google is undervalued relative to Meta over here. I use this as sort of like an estimation, not so much to value a stock. Next valuation method is simply just your asset-based method over here. So this method over here is for companies that own assets as well as deep value companies over here. So you have your railway companies that own hard assets like your railways. So what you can do for this valuation method over here is to compare the book value to the market cap of the stock. If the book value is greater than the market cap, then these stocks are undervalued over here. But the problem with this method is flawed as well, because some people prefer discounting assets and inventory. People typically use this method for nets over here. So inventory is not worth as much as cash. Hard assets like railways are not worth as much as cash as well. So you need to sort of like estimate how much to discount off the actual value of the railway itself. And that is the problem with this valuation method over here. The last one is simply just to use your discounted cash flow model as well as your EPS model. Those ones I've talked about in another video already. Last portion over here, I'll be covering some of the questions that you guys have left in the comment section below. So the first one over here, it says, great episode as usual. An episode on how to do position sizing, how to buy a full position or slowly DCA into a stock, how to handle price anchoring would be helpful for me. So let me talk about the buying of the full position as well as the DCA over here. So what I tend to do is I tend to set buy tranches over time, basically price targets to buy into my stock. So I'll buy at 10% undervalued, 20% undervalued, and so on. I try and buy in tranches because you never know where a stock could go. A stock could drop 10%, and then if it drops another 10% and you already bought your full position, then you miss out on the entire 10% drop over here. So for example, Google over here was a company that I added quite heavily last year as well as this year as well. The company was trading at around $200 a share, and then I was adding all the way down. So I added at around $180 a share, $170 a share, all the way until $138 a share. That was the last add for me in Google over here. So I tend to add in tranches, basically DCA, not so much the full position method where I just lump sum everything inside. I'm more comfortable with the risk when it comes to the DCA method as compared to just lumping everything in a full position at one go over here. As for how to handle price anchoring over here, I think it's just human nature to price anchor. Meaning to say, when you buy a stock and then the stock goes up already, you stop buying. So even the greatest investor in the entire world suffers from it as well, Warren Buffett. So he's price anchor as well. And yeah, the only way for you to solve it is to simply just move on and find other companies that provide better opportunities. Price anchoring is just human nature over here, so it's almost impossible for you to 100% avoid it, but you can train your brain to be less affected by it. Next question over here. Hi Quanray, what do you think about CUS? Basically the Singapore company over here. Personally, I believe it's a high quality compounder and has a strong moat in various countries. It provides a decent expression of a bullish view on Southeast Asia region as well. So for C over here, I view it as a company that is in a very competitive market over here. So for example, you have Alibaba with their international segment as well, and the international segment also targets Southeast Asia as well. You have C Limited with Shopee and all that targeting Southeast Asia as well, and then you have Grab, which is coming out with their own online catalog as well, targeting Southeast Asia as well. So for C over here, I view it as a company that is in a competitive space over here, and for me, I don't think C is an extremely high quality company. I think it's still in the growth phase, and for me, I'm more comfortable adding to companies that are sort of like maturing already rather than to buy companies that are still in the growth phase over here. So if you're to look at C, for example, C, they just became profitable I think 1 year ago or so, And for this business over here, it is still trading at a very high valuation because it's growing rapidly. But for me, I feel more comfortable buying stocks that have a history of strong and growing earnings over here, like for example, MasterCard, Visa, MSCI, all these different companies that have a strong history of growth. But for C over here, I could see it working out, but for me, it's a no-go. Shopee is still trying to gain market share in Southeast Asia by providing free products and all that. And typically when a company is still needing to basically give out free products to gain market share, it is not a very good sign. It means that the company doesn't have a competitive edge ahead of its other peers over here. So for me, I would avoid C. For me, it doesn't fit into my investment bracket over here. I hope you guys have found this one useful and invest.